In the first two chapters, we learned how to analyze, journal, and post accounting transactions. We took a quick look at financial statements that are typically prepared in accounting, but in this chapter we're going to go into more detail about some of the steps that have to be done to prepare financial statements. And in order to do that, we need to first talk about the accounting period and the difference between accrual and cash basis accounting. So let's talk a little bit about accounting periods. We've already mentioned this before, but basically in accounting, generally speaking, people have a 1-year accounting period. So we publish annual reports, but most companies report also on an interim basis, and that might be 1 month. It's often a quarter, semi-annually, or annually, and those are referred to as interim financial statements. And that information that is given to investors it needs to be timely. It needs to really express as closely as possible how that company did in that particular period, whether it's a month or a year. Most companies have what's called a fiscal year, which doesn't necessarily go from January 1st till December 31st. If it does, then that means the calendar year and their fiscal year are the same. But often companies' fiscal year, meaning how they measure their year for accounting purposes, does not match up with a January 1st to December 31st. Such as Walmart and Target and these department stores, their natural business year ends on January 31st. So their year does not go from January 1st to December 31st. It goes from December 1st to, it goes from February 1st to January 31st. And that's because it follows their natural business cycle, meaning wait till after the holiday season before you wrap up your business for that particular year. Let's talk a little bit about accrual basis versus cash basis. Most of us, in terms of our own checkbooks and stuff like that, we basically work off of cash basis accounting. When we pay out cash, that's when we record it. When we receive cash, that's when we record it. Which you do that too in accounting, but there is a difference. U.S. General Accounting Principles requires that companies use accrual basis accounting. There's some examples where you can use the cash basis, but they expect you to use accrual basis accounting. And the reason for that is because they believe that it matches revenues with expenses more clearly. In order to do accrual basis accounting, you have to make some adjustments at the end of an accounting period. You have to be able to show that, let's say you have I'll give you an example. If you paid rent for the whole year on January 1st and you paid it for 12 months in advance, then at the end of January, even though you've already paid that, let's say you paid $2,400, which would be $200 a month. At the end of January, you've already paid it. You've paid $2,400, but that expense is not really all to be in January. That expense is to be stretched out over the whole year. So your financial statements at the end of January should not show $2,400 in rent expense, because it should only show $200, because the expense for that particular month is only $200. So even though you've already paid it, you want the expense to be shown $200 a month for the whole year, not $2,400 in January. And so in order for that to happen, you have to make an adjustment to the books. And we're going to talk about how you go about doing that. But that's the basic difference between cash and accrual, is that you want to make sure that you're actually matching the expenses and the revenue to the period in which it really should be applied, not necessarily when you paid it, because that whole expense should not be in just 1 month. It should be stretched out over a year. That may not make complete sense right now, but we'll talk about individual examples of that here in a minute. So again, this explains what the point is and why we have to do it this way. It has to do with when you recognize the revenue and when you recognize the expense. If you record revenue when you receive it, you're going to overstate the current period revenue and you're going to understate a future period. Meaning, if somebody pays you in advance for a job that you're going to be doing over 3 months, if you record all of that money in the first month that you receive it, then you would be overstating the first month and understating the second month and the third month. And the same thing works with expenses. If you pay an expense in advance, but if you record the whole thing in that first month, you're going to overstate the current period expenses and you're going to understate future period expenses. So that's the reason why we have to do these adjustments. It's based on 2 principles, revenue recognition and expense recognition. Revenue must be recorded when it's earned, not necessarily when you receive it, but when you earn it. So a major goal of the adjusting process is to have revenue recognized in the time period when it's earned, and then the same thing is true with expense recognition. It aims to record the expenses in the same accounting period as the revenues that are earned as a result of those expenses. So you're trying to match expenses with the revenue that's actually earned from those expenses. For example, this is a company that actually was investigated because of the way it was reporting its revenue and expenses. They were postponing expenses related to payments to its walnut growers. This alleged late expense recognition caused their income to be overstated in 2011. So if you don't recognize the expenses at the time that they're really incurred, you postpone them to the next accounting period, then that is going to make it look like you made more money in that earlier period than you really did. And sometimes companies try to do that to boost their stock prices, to get people to think they're making more money than they really are. And so this is why US GAAP expects us to match revenues with expenses, and why we therefore have to make some adjustments at the end of an accounting period to make sure that that happens. So in the next video, we'll talk about how those adjustments are actually made.